Well, the last time Steve Leuthold was on with me, this was in October, he said he was worried about what 2011 would bring for investors because of the budget deficit and that QE2 would be bad for confidence. Well, back with us now is Steve. As you know, he's the founder and the chief investment officer at the Leuthold Group. He's joining us on the phone from Maine. Steve, great to have you back with me.
Betty, it's nice to be talking to you again.
So what do you think, Steve? I mean, I know, you were warning us that you were worried about 2011. So this sell-off can't be a surprise to you.
Well, no, it really isn't. We expected the market to peak in the first half of the year, and, that old advice, sell in May and go away, it looks pretty good these days. But I think you did see the high for the year back at the end of April, and I don't expect any disaster here because I'm still hopeful that the U.S. is going to come to its senses in terms of fiscal responsibility and take some steps. But in addition to that, compared to, say, the rest of the world, currently, if you look at the action of the 10-year bond, things look pretty good in the United States compared to other places. We're sitting here right now very close with our model, very close to median valuation levels for the S&P.
Okay.
And actually, I think our number is 1245, and I think we're only about 10 points away. We may see it today.
Yeah.
And I'll probably lift some of the hedges that I've had on really for the last 6 or 7 weeks. So I expect we're pretty close to some type of a significant rally point. The one that we saw on Tuesday was short covering, it looked like. We took that all back the next day. But I really think we're probably close to an area where we're going to get some significant bounce. So this isn't any time to sell.
A rally of what, do you think? A rally of how much, Steve?
Oh, it'd probably go farther than people expect. Maybe it's going to be spurred by some settlement of what's happening in Greece, like perhaps arrangements for Greece to make an exit back to the drachma from the euro. But I think there is going to be some kind of a shift in confidence here. We've gone too far, too fast, and we're really oversold. So maybe back to, I don't know, maybe 1,300, something like that on the S&P.
Right, so we are about 20 points away of what you're talking about, which is your buying is what you're saying, Steve,
well,
right?
Only about 10 points away right now. 1245 is our number, and I think the futures are about 1255 right now.
Right, I'm looking at the close yesterday, but yes, you're right about that if you're looking at the futures. So where then, are you still fully invested or still fully invested in the stocks in your portfolio, or have you taken some off?
In our mutual funds, asset allocation funds, we're only 60% in stocks, but in the partnership that I run, we're only about 35% in stocks, and that's where I'm going to be probably lifting the hedges.
What are you going to be buying then?
I'm tending to focus on foreign investing in strong currency countries. And I think the U.S. still has major problems in addressing its deficit. So I'd feel more comfortable in places like China, in places like Singapore, perhaps even in Canada. So my focus would certainly be investing outside the borders of the U.S. in markets that are denominated not in dollars but in strong currencies.
But Steve, you just said, though, that you think that we're poised for a rally here in the U.S. So within the U.S. and in your U.S. portfolio, what is attractive to you now?
Well, the biggest part in the U.S. portfolio, and it's been there for about a year and a half, is in really the healthcare management companies, the ones that have been so out of favor and are so really cheap. And they've performed extremely well for us this year. I think the idea that the U.S. is going to be able to handle the Obama health care program without major assist from the operators is a fiction. So there's a place for these companies, for the Aetnas and the Humanas and so on and so forth, and they're cheap, 10 times earnings.
Last time I talked to you, Steve, I know you mentioned those companies before, but you also were starting to buy into Citigroup and looking at some of the regionals. Have you bought more?
We're about in our portfolios were maybe 6 or 7% in what you might call diversified financials, which include Citicorp and ING and so on and so forth. And I'm a little concerned about them in terms of their holdings on a global basis, especially in Euroland. So I'm not selling anything, but I'm not at this point adding any more there.
And you don't see anything attractive in some of the major Wall Street companies or firms like the Goldman Sachses and the Morgan Stanleys?
Oh, I suppose, but in our disciplines, that whole group doesn't grade out very well. The brokers and the dealers and so on and so forth. We actually do have life insurance companies where we've got about a 7 or 8% holding in the U.S. portfolio, and I think they look sane and fairly safe. But and I think the banks generally, the regional banks might be interesting too. But at this point, in terms of the diversifieds, the Citicorps and so on and so forth, I'd kind of hold off there for a little while before adding more. They look really cheap, but then we don't know how much of those earnings can disappear rather quickly with currencies.
Steve, thank you. Inside the Mind of Stephen Leuthold.